Today's episode is sponsored by Raisin UK. Apply to open savings accounts with over 40 banks and building societies and manage everything under one roof. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link in the show notes or go to raisin.co.uk/pensioncraft. Gilt yields are surging, straining government finances and raising fears of tax rises or spending cuts. But is this a UK-specific problem, and will the Bank of England be forced to respond?
Our guest today is economist Simon French, who brings a wealth of experience from investment banking and working at the heart of government. And in today's dumb question of the week, we ask, why does the government need fiscal rules? All right, let's get into it. Today, we're delighted to be joined by Simon French, Chief Economist and Head of Research at investment bank Panmure Liberum. Simon writes on economics for The Times and previously worked in senior government roles at the UK Cabinet Office. Thanks so much for joining us, Simon.
My pleasure, Michael.
So it's a sad day when I'm excited to talk about bond yields, but here we are. So last week, UK borrowing costs made headlines for the wrong reasons, with the 10-year gilt yield hitting a post-2008 high. And the further out you went on the yield curve, the worse it got, really, with the 30-year bond yield reaching 5.4%, which is the highest since 1998. So, Simon, what is going on with this surge in yields?
Well, first and foremost, thank you for having me on the podcast. And there is nothing boring about bond yields. The challenge, the challenge is to explain some of this stuff particularly to the retail investor or the non-financial markets participant without bringing out sort of cliches about 007 or something that a US politician said 30 years ago. That's your staple when talking about the bond market. So I'll try and avoid all those cliches. But look, what is going on in the last few sessions is largely economic events, economic data, economic uncertainty, the other side of the Atlantic from where we're recording this in the UK. We've had some strong US economic data pointing to a stronger jobs market than many had perceived, more inflationary pressure, fewer rate cuts from the Federal Reserve, which of course sets the value of money around the world. But with an overlay as well that UK fiscal policy looks rather looser than you would want at these levels of interest. And also the fact that growth, having been pretty strong actually in the first half of the year, the UK, and it's easy to forget actually right now, the first half of 2024 was the fastest growing economy in the G7. It feels like a long time ago, but the data has definitely deteriorated. Put that all in the melting pot. Actually, people buying UK government debt right now are demanding considerably higher yields than they did just a couple of weeks ago.
So just to step back a moment, certainly the long end of the yield curve is driven by growth, inflation expectations. But in the UK, we're in a strange situation because we're very much exposed to US rate changes. And this is a global phenomenon, isn't it? We've seen rates increase across the entire developed markets.
That's absolutely right. And the UK is something of a price taker for its cost of money. Now, of course, the Bank of England, if it's feeling uncomfortable about how tight financial conditions are as a result of this, could step in, either using its primary tool, which is interest rate cuts, or indeed its other toolkit, which is its balance sheet and slow the pace of divestment of gilts. I'd rather favour the latter because I think we do have some fears about stubborn inflation, and also that is likely to be amplified if the Bank of England goes on a more aggressive rate cutting cycle than the Federal Reserve through the impact on the exchange rate and specifically on sterling. And while sterling, I think there's been some poor commentary on what's going on with sterling. Sterling has definitely weakened versus the dollar, but has actually remained pretty stable in recent sessions on a trade-weighted basis, certainly against the euro, which is the other big cross rate. So I think there are a few more options for the Bank of England to be a bit more dovish on current FX. But of course, the fear would be that if it really took a really strong dovish pivot, you'd start to see weakness across all the currency pairs, and that would start to push up imported inflation.
It does seem slightly strange, doesn't it, that we're in a situation where yields are rising quite rapidly, and yet the Bank of England is selling a load of bonds into the market with QT, quantitative tightening. Are they making a mistake there? Are they sort of adding fuel to the fire?
Well, first of all, case for the defence for the Bank of England. It has started, like all the major central banks, actually ex-Japan, on divesting its asset purchases that's taken place over the last 15 years since the global financial crisis. And the pace of that divestment has been slightly faster than the US and not quite as fast as the ECB if you look at the proportionate drawdown since balance sheets peaked during 2022. But, and then you knew there was a but coming, it had to do that through active sales of gilts rather than passive sales, because the UK debt stock, its gilts, are rather longer duration than Eurozone bonds and treasuries. Unadjusted for quantitative easing or the bank's balance sheet, we've got a duration of about 18 years, which compares to the US debt burden, the Eurozone debt burden of about 5 to 6 years. So as a result, if we just did maturity divestment from the bank balance sheet, it would take a lot longer for it to normalize its balance sheet. And by the way, I use the word normalize with no idea what the normal size of a central bank balance sheet is. The good news is neither Jerome Powell, Christine Lagarde, or Andrew Bailey, they're all guessing, and quite frankly, they're divesting until such point as something breaks.
I mean, we're in uncharted territory, really, aren't we? We haven't seen bank balance sheets grow like this before, really.
We haven't seen them grow like this, and we haven't seen them shrink like this. We saw some shrinking from the Federal Reserve in 2017, 2018, which came to a hard stop when something started to break in the US money markets. Are we at a point again where banks go, perhaps conveniently, central banks that is, that we've divested enough of our holdings and financial conditions are too tight for what the underlying economy wants? But I think that's probably my thesis here, which is that a little bit of pulling back off the brake pedal through financial conditions from active sales from the Bank of England would actually be quite a smart move at this point. It will still divest of about £85 billion this year, but taking off a little bit off the top, which they're going to do in active sales, which has fiscal implications in the UK. It costs the Treasury to indemnify the Bank of England against losses. And if you don't let your bond portfolio run to maturity, you're selling at less than par, you're creating losses, and the taxpayer actually ultimately has to pick up the tab.
Yeah, at the moment, just to be absolutely clear, the sell-off is orderly, isn't it? It's not the case that there's no liquidity in the Treasury market, or that it's a one-way market, or that the Bank of England's going to have to step in to stabilise markets, as we saw during the big sell-off during the Truss Kwarteng episode.
Yes, I think you're right. There was a very asymmetric move back in 2022, this is, partly due to the mini budget coming a bit out of left field in terms of its policy prognosis, partly because of the LDI issue that was spoken about in obscure corners of financial markets but wasn't widely acknowledged, but also a very, very different energy market backdrop. And that triggered an intervention from the Bank of England. We have to say, a very successful intervention. It made a considerable profit on its interventions of buying bonds, particularly at the long end of the curve, to bring 30-year yields down and bring some stability to that market. We're probably not there at the moment. You're right. This isn't disorderly. This isn't quite as asymmetric for the UK.
I should say we're recording this on Monday morning, Monday the 13th, so who knows? By the time you listen to this, the Bank of England might be all over it.
Well, I mean, Michael, you've actually teed up the next sentence I was going to say, which is things can move quite quickly. And as a central bank, as a financial stability guardian, you want to be ahead of the story. You don't want to be behind the story. There's nothing worse than having to react to events and being seen as, if you excuse the cliche, being behind the curve. So as we're making this recording on Monday morning, the Bank of England hasn't yet taken proactive action. But if we start to see bond yields rise asymmetrically in the UK, we start to see sterling weaken across the currency complex, then they may live to regret that decision.
So just turning to government finances, because you hinted that it has an implication both from the QT side of things, but also just when we're paying a higher cost of borrowing, that is eating away at the so-called headroom that the government has. And I believe at the budget, it was around £10 billion of headroom, which some people are saying is now gone.
Yes, and the Treasury have come out with a rather sort of defensive line, which I don't think anybody believes, which is, well, there's only the OBR that can make that calculation of how much headroom there is because there's lots of moving parts. We can all do the math, and quite conveniently, actually, the OBR produce a ready reckoner for public consumption on if you see a 100 basis point increase across the gilt curve, that reduces the government's headroom by conveniently about, well, just shy of £10 billion. So I don't think it's unrealistic that independent economists have said, look, this move in the gilt curve has knocked out the headroom. Yes, there are other moving parts, but some of those other moving parts are not particularly favourable either, since the OBR projected back at the end of October the growth data for next year, and of course now this year, 2025, where the OBR sees the economy growing 2%. I have to say the downside risk to that number has grown quite appreciably given latest PMIs, latest confidence data. So I think you make an absolutely reasonable assertion that all else being equal, and all else is never equal, the movements in bond yields has eliminated that headroom and leads to a particular challenge for the Treasury as to what it's going to do around the 26th of March, when the OBR provides its first forecast of 2025, which may well say the government is close or if not breaching its current fiscal rules.
Now, I see that the actual spending on debt interest for the UK was 102 billion in 23-24. So that's just a shade under 4% of GDP, or about 8% of government spending. A third of our debt is inflation linked. So obviously, after we've had this inflation spike, prices are about 20% higher. Do you think it was a mistake to have so much inflation linked debt?
Wow, we could probably do a whole podcast on this. And I have written a column when Robert Streatham, who was the head of the debt management office, recently retired. And I said he'd done an excellent job. And I'm not going to change my diagnosis there. There is large institutional demand for RPI-linked debt from our outsized DB pension scheme in the UK, at least until the most recent spike in inflation. That had been quite a profitable way or quite an attractive way for the government to raise debt because the yields were relatively low. But you are right. If this isn't just a one-off shock, which we're seeing reverberations from in the energy market, but actually we're going to see a sustained period of higher inflation, that is going to be more expensive debt. Now, just to put some numbers to what you said, I think the 23-24 rolling data just north of 100 billion. I think it's closer to about 80 billion on a run rate on the current rate of RPI, because RPI has come down a long way. But clearly, if either currency weakness or events in the global economy become more inflationary, that's going to ramp back up and put further pressure on the public finances.
Do you see UK inflation as a sort of unique problem? It seems that services inflation is sticky, wage growth is still strong and maybe unsustainable. Are we in a different position from the rest of Europe?
Certainly to the rest of Europe, but this is not something recent or unique. Actually, at least until recently, I haven't run the numbers since. If you actually look, since most central banks gained policy independence in the mid 90s, and in the Bank of England's case, 97, 98, actually UK CPI has averaged about 2%, or within about sort of 10 basis points of 2%. Actually, the ECB materially undershot. The Fed actually undershot, and of course the Bank of Japan very much undershot over that period. So while we don't have a price level target over the last 25, 30 years, actually the UK has had higher inflation, but consistent with its inflation target. But you're absolutely right, the most recent data taken over the last perhaps 3 years does suggest something of an outsized problem with UK inflation. But the suspects for that are many, and not always the ones that perhaps the Bank of England's central forecasting model would suggest. They might suggest the supply side has been impaired post-pandemic, post-Brexit, and therefore actually what they describe as the run rate of the economy, the amount of growth you can have before it becomes inflationary, has come down. But I would take a slightly different view, which is we have a lot of regulated prices in the UK. Regulated prices, for example, in low pay, which take no account of the output gap, the Phillips curve, the type of workhorse assumptions that central bank models use. Actually, they're just regulated on lagged inflation to hit a policy target to get the national living wage to two-thirds of median income. You have other areas, regulated rail fares, broadband contracts linked to lagged CPI. So what you have actually, and this is where my model for inflation differs to a lot of other forecasters, is the most powerful driver of inflation in the UK is inflation T minus one, so last year's inflation. So you have a series of echo effects through the regulated prices rather than, if you like, structural factors. So that's why, if you like, UK inflation, in my view, has hung around a little bit longer because the amount of prices that we regulate on lagged inflation, rather than necessarily those structural factors that a lot of perhaps make a bit more of an appealing academic argument, but I don't think stacks up to what the data is telling us.
Certainly, listening to the Bank of England doing their press conferences, they stress the fact that people are trying to catch up in terms of personal wages, but also companies are trying to redress some of the losses they made during the period of very high inflation. So do you think that's also a factor?
I think that's a very good additional factor to all of this, which is, again, talking about lags and quite considerable lags. We talk about lags in monetary transmission from interest rates, financial conditions to economic activity, but also lags in terms of price setting and something of a catch-up process. I do think that is correct. And that makes it really hard to know what the right level of financial conditions and monetary policy is for aggregate demand, given the price signals may be suggesting a very different demand and indeed supply picture than actually the underlying economy would require or indeed justifies.
Do you think the Bank of England is kind of stuck between a rock and a hard place? Sticky inflation on one hand, stagnant growth on the other hand. Stick or twist, right?
It's a tough task. It is a tough task for Andrew Bailey and the Monetary Policy Committee.
What's the market expecting over the next year?
Well, this is the thing. I mean, 1 to 2 rate cuts. I mean, I think it was only one is now fully priced. As of Friday's close, it was only one is fully priced, about 45 basis points. So we didn't quite get to that 50 basis points for 2 cuts. But if you contrast that with the ECB and the Eurozone, which is pricing about 5 to 6 cuts, demand conditions in the UK look much more like the Eurozone and much less like the US. And yet the monetary policy expectations in the market are much more like the US and much less like the Eurozone. So there's a dichotomy which is only really explained by what you are alluding to, which is the fact that you've got fears over some quite sticky, persistent inflation, which reduces the wriggle room for the Bank of England compared to those other two major central banks.
Are we being too negative here, though, on the UK? We're kind of talking it down. I guess since Labour came to power, it came in really with this sense of optimism and then had a long time to wait until it was going to give its budget, and this talk of black holes and everything, I think, just depressed everyone, right? And we saw consumer confidence fall, business confidence fall. Is there a prospect of growth going forward?
Absolutely.
And has the government made a mistake of talking down the economy?
First thing first, I get lots of stuff wrong. It's an occupational hazard of being an economist. He comes with the territory. You'd be delighted to go through your career and get 51% of calls right. But at the start of August, and you can pull the tapes, you can pull the sort of Times column I wrote at the time, I did say that this talk of black holes, of the worst economic inheritance since the Second World War, risked being self-defeating. And I understood completely why, from a political standpoint, they wanted to pin it on the opposition, as George Osborne did so successfully with that famous letter, or I think it's famous anyway, from Liam Byrne, the Labour Chief Secretary of the Treasury, who said there's no more money. He wanted to pin it on the opposition. I get it. I don't have to run for elected office, so I don't have to do such things. But if your primary mission is growth, talking down animal spirits is almost the worst thing you can do. Now, at the time, back in August, I would have to say I didn't get universal support from my peers who thought that, animal spirits, how you talk up or down the economy had very little impact. I like to think that the data, I don't like, because I'm a, well, no, I think we can be patriotic, can't we? I want the UK to be successful. I'm very patriotic. I want the UK economy to return to being at the sort of top table in terms of growth, in terms of well-being, household income, all the key important metrics. I just think that it was either a naive calculation or politics overtook the economics in the Treasury to peddle this narrative. And you could see that there was a U-turn in about mid-September where they recognized it was self-defeating. I think there was some GfK consumer confidence data that landed in mid-September, just before the party conferences, and you could see the change of tone. But by that point, a lot of the goodwill that the government had, businesses had, or were giving government had evaporated, and it's very, very hard to recapture that.
I mean, they were kind of saying the beatings will continue until growth returns, which is a hard message, really.
It is a hard message. Now, look, attributing why that was the strategy is difficult because others have analysed the experience of the current cabinet, the current cohort of Labour MPs, and noted a lack of business experience. Now, again, generally speaking, I don't put too much stock on what your CV says, but what's your capability you bring to the party, and you don't have to have worked in a certain sector to have certain skills.
Thank God, or my career would be down the tubes.
But, and you knew there was a but coming, I do think if you've worked in the private sector, if you've had to run your own business, you have to be an inherent optimist. I think. I mean, I find very few salespeople who are pessimists, who are dour. They're upbeat, and some people find that a bit uncomfortable. They go, it's all a bit boosterish. But you know what? The boosters have a pretty decent track record, both politically and economically. Look who's going back into the White House next week. You look who got the biggest, or at least until the last election, the biggest majority in recent UK political history, Boris Johnson. I mean, people want to follow, want to support positive narratives. And while it can't do everything, I think it can do quite a lot of the heavy lifting, and I think it was a bit something of an own goal. And there are lots of structural challenges that the government is right to cite. Let's not hide away from them: an aging population, a skills gap, the debt burden, very benign productivity growth for a long period. Let's not kid ourselves; they don't exist. But equally, all those challenges are made harder if you also stamp on animal spirits.
Today's episode is sponsored by Raisin UK, the free, easy-to-use online savings platform. Access exclusive savings accounts today and manage everything under one roof. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link in the show notes or go to raisin.co.uk/pensioncraft. I mean, just casting my mind back to when I was a strategist, whenever you talked about things that would really move the economy, we usually looked at things like credit impulse, where you look at the change in the size of the debt relative to its previous size or compared to the economy, and that's how big the bazooka is. Now, the UK, there was no real bazooka at all. They had these fiscal constraints, they had fairly limited increases in spending. And so there wasn't much of a credit impulse at all. So I was quite negative when they announced the actual policies. So do you think there are any growth stimulating policies in there, or is it all just talk?
No, I do think there are growth stimulative policies. And the one that we will hear a lot about, I suspect, over the next couple of months, you could argue we've heard a lot about it already, but that hasn't translated into action, is planning reform. Now, a number of people roll their eyes when you mention planning reform because it's been promised as long as you and I have been strategists, and it hasn't crystallized because of local opposition, particularly in terms of residential planning, but also local opposition on critical national infrastructure. And it adds cost, it adds time. It is, my newspaper column this morning talks about there's plenty of attractive investment propositions to deploy capital into the UK. I see them every single day. But what I hear again and again from CFOs and CEOs is the cost of capital deployment, the time, the lead-in time is just punishingly long, and it deters investment. I have seen signs from various government departments, Angela Rayner at Homes, Communities and Local Government, Ed Miliband, who divides opinion on his energy policy, but he has approved a lot of particularly renewable energy projects and accelerated that process. And he's also talking about regulators getting a better balance between risk and reward. And I think that's long, long overdue. Those are the type of things which, curated together with a sort of front person who can sell this is exactly what the UK wants to be achieving, to get greater capital deployment, get greater investment, get that impulse that you're talking about back into the economy. But I'm afraid it's just been drowned out. Those accretive actions, those signs of progress have been drowned out by the negative sentiment.
Okay, well, that was sounding a little too positive for my liking. I want to bring it back down to the doom and gloom. So, from the point of view of an investor here, surely it can't be good for risk assets if long-term yields are above 5% now. Like, what's the picture and the outlook for, UK stocks and I guess global stocks, really?
Well, let's start with the UK first, because I think it is a special sit in terms of its stock market. It has been at a persistent discount, certainly since the Brexit, indeed since the Brexit vote of 2016. Actually, it feels a long time ago, and of course it is more than 8 years ago, 8.5 years ago. But UK stocks, the FTSE All Share was at a valuation premium to global equities in early June 2016. It's extraordinary to think about it, because my own analysis of other investment banks has suggested that even if you control for sector composition and the growth outlook of the underlying companies, we'd recognize the UK market is underweight, big underweight on tech. It has a lower EPS growth profile in terms of consensus EPS estimates. But if you control for those factors, you still see a discount of about 20%. It's very rare, and that's on a weighted average of price earnings, EV, EBITDA, price book. Very rare that you see a fairly significant developed market, a stock market at that discount, but it's existed for a long time, and economic factors have waxed and waned over that period. It's why, actually, and this is what I say to investors looking, and they are looking at that long dated discount and going, actually, we'd like to arbitrage that, like to buy into that. I think it comes down to whether pension funds, the UK's £3 trillion pensions funds, are going to change what has been a 3-decade divestment of both risk assets and UK risk assets. There was a very, I thought, good report from the Pensions Review interim report with a research annex, which showed the compared, I mean, everyone compares stock markets to the US. It's not a great example, but compare the UK to Australia, to Canada, to New Zealand, Anglo-Saxon, mid-sized economies, and their pension schemes they've done a little bit of divestment of their domestic market, but nothing like on the scale of the UK market. And so if you believe in a re-rating of the UK market and increased relevance and attracting companies, private companies, to come and raise equity in big numbers on the UK market and start a re-rating cycle, you have to believe that there'll be some either carrot or stick, and both are being debated in terms of tax incentives, British ISA.
Our audience is getting worried, Simon. You're going to force them to buy British assets.
No, hang on. Well, so look, there's the carrot or the stick. That is the stick approach, which is mandation. And I get why people are deeply uncomfortable with that. I really do.
Yeah.
But if you are, as a pensions review, told that fiscal questions, dividend interest tax relief, British ISA, pension interest tax relief are off the table in terms of recommendations, then it takes you down this route, stamp duty abolition, which is only levied on UK stocks. It is bonkers.
Yeah.
It is bonkers that the cost of buying a UK share for UK investors is higher than international shares because of stamp duty.
We can all agree on that.
Yeah.
It is also pretty bonkers, although you can debate this in different ways, on depending on whether you think pension interest tax relief should have a line of sight to the cost of capital for domestic companies, or whether it's solely an incentive for saving. If you think it's solely an incentive for saving, then you would say, well, it should be agnostic of geography. But if you realise that the cost of capital for UK public companies, and by extension private companies, is a function of that allocation decision of your domestic pension fund, then the fact that it is agnostic whether you buy Nvidia or UK technology stocks probably needs a bit of a look at if you're going to reconfigure those flows, those sustained outflows out of UK equities. It's a really passionate, vibrant debate, and I recognise, given where I work, I'm pointing at this logo obviously behind my head.
Yeah.
I get that I have a vested interest in this. I'm never hidden from it, but it also means that I see day to day, and I have a fair amount of expertise on this, why private companies don't raise money in the UK, why public companies go private, and what that does to the cost of deploying capital, the health of our stock market, the health of UK growth. So I do see it, while I fully acknowledge that where my seat is means I have a vested interest, doesn't mean I don't have, I hope, something valuable to offer to the debate.
But is this getting the cause and effect mixed up? For example, could it be that the lack of success of UK companies, relative to US companies I'm talking about, isn't because they're starved of capital, it's because they haven't managed to scale their businesses in the way that the US has managed to scale their businesses? It's not that we don't lack, we've got so many bright people in universities, we've got the infrastructure in order to scale these things, but for some reason we just don't have that model which you get in Silicon Valley, combining this kind of tech hub with capital and the ability to blitz scale these companies.
So I don't think it's one or the other. I think you're absolutely right that the operational barriers, the skills barriers, the ecosystem does not lend itself to scale on anything like the same rate as that example you give. But we must also, I think, to be even-handed, recognise that there's an endogeneity there of the cost of capital environment, particularly in public markets, on that ability to scale, to acquire, to consolidate, to grow, to go back to the public markets and raise equity. If that is at a persistent discount, that does disincentivize that scaling up behavior, at least in public markets. And if that also blocks the pathway of funding from private through public markets and that ecosystem, then that does become an impediment. So yes, I'm not, by the way, no one should ever confuse what I'm advocating for here in terms of the tax ecosystem favouring UK listed assets as solving all the problems on the growth side and the scaling side of the UK economy. But do I think it's part of the challenge to scaling and growing the UK economy? Yes, I do.
I guess I just wonder that if UK equities are sort of unfairly cheap, shouldn't that be enough in itself? Or is it always that you need a catalyst to get this re-rating?
I can only speak for what I hear from US investors, who are the largest single buyer of UK equity, and they want to buy more. A few years ago, you saw people going, well, it's all compositional, it's all a bit sectoral. Actually, we're not quite convinced it's a real discount. There's almost no debate now. Absolutely, they acknowledge there's an arbitrage, but they also saying, well, hang on, as your domestic pension system keeps selling your market, and therefore performance, liquidity, this pro-cyclical, what others have called the doom loop, means we don't want to get in the way of that. There's a fund manager in Chicago said to me, the moment you start buying your market, I'll put that in because I'm absolutely going to follow you. But you guys have got to go first.
Yeah.
And that is the argument, if you like, for maybe only a relatively small amount of pump priming at the front end, because actually, look at asset classes. Well, we're focused on UK equities, but look at asset classes, including fixed income, crypto assets, FX. They are so pro-cyclical. Trend bequeaths trend, momentum is everything. And so to some extent, what has been the big impediment to UK equities could very quickly, in my view, I may be wrong, of course, could very quickly go in the opposite direction. You start to get momentum where people want to see, actually, I want to follow what is an inflection in performance, a long-dated underperformance.
I guess we saw a little bit of that in Japan, didn't we, last year, where they had a big rally?
Yeah, I mean, that speaks to the fact that this is a phenomenon in price setting, and many have linked it to the growth in passive investment strategies. A growth of geographical allocation to the benchmark has been an impediment to the UK, which has underperformed, and been a massive tailwind to the US that has kept outperforming and accruing assets. But you are absolutely right. The market structure is such that if you start to inflect, it can move very, very quickly in your direction. Now, I fully get that some people are very uncomfortable with that, but it is my view on how you need an external catalyst to get the market moving.
Investment's very much a narrative driven activity. So, how would you describe the narrative? If we're going to be positive about the UK equity market, what do you think would be our selling point? Is it just that we're cheap? Or do we have something special, some secret sauce, which makes us worthwhile as a target for investment?
Well, so we're definitely cheap. So there is definitely a valuation opportunity there. So that is the, if you like, the cornerstone of the UK. But also, look, if the UK market was full of, uninvestable opportunities, as some like to present, why is there so much public to private transactions at the moment, a very, very considerable premium?
Yeah.
Private investors are not saying, we'll do you a favor by, bailing out the fund manager who's got outflows by buying out some of its portfolio so he can deal with his redemptions. They're buying it because they're looking at the assets that are on the public market and going, that is at a fundamental discount to embedded value. So if these discounts were, if these premier share prices were 10, 20, 30%, I'd go, okay, well, that's a sort of, reasonable range. But some of these premia are, in some cases, north of 100%. That is telling you that, particularly in the mid and the small cap space, less so
Yeah.
at sort of very large cap, that is telling you, in my view, that there is a disconnect between embedded value and what public equity is valuing these assets at.
Yeah, certainly my UK small cap portfolio is bleeding at the moment. So I just hope you're right. But, I keep putting money into it thinking, oh, it's going to turn around, but it hasn't.
Yeah, I mean, look, I fully understand why people buying into that strategy have been burnt. And part of it was linked, of course, to speculation over inheritance tax relief on AIM shares, which is a big part of the UK small company ecosystem. And that speculation was unhelpful. But as I say, I would go back to the fact that within that small mid cap ecosystem, there is still, and I don't want to inadvertently bring you guys over the wall, but there's still a lot of transactions going on, or a speculation going on around public to private, because a lot of private capital is going, well, the best place to go and buy assets is currently on the UK public markets.
Now, a bond sell-off in the UK gilt market is actually an opportunity. If you want to learn more about investing in government bonds and their tax efficiency, a great way to do that is as part of our community. To learn more, just go to pensioncraft.com/membership.
Okay, today's dumb question of the week is, why does the government even need fiscal rules? So, as I understand it, we're now onto the 10th set of UK fiscal rules since New Labour introduced them back in 1997. And those 10 sets of rules have comprised of 28 different individual rules, some of which were met, some of which weren't met. I guess they're there as a signal to markets, but what is the signal if we keep changing them?
Well, the signal lacks credibility, doesn't it, if you keep changing it? And while critics of fiscal rules would say, well, let's just jettison them completely, I think 2022 acts as a salutary tale of, if you remove the institutional architecture, replace it with nothing. And in the case of 2022, this was sack the top civil servant to the Treasury, sideline the OBR, negative brief against the Bank of England, what I described the institutional scorched earth policy.
Yeah.
It's not very smart. And investors look at that and go, okay, all right, they're not perfect. And the OBR certainly aren't perfect. The Bank of England haven't been perfect. Treasury the Treasury view is certainly not perfect. But hang on, you guys have not exactly covered yourself with glory in the previous 12 years, bringing Brexit, pretty sluggish productivity growth, etc. So, I think that is why this institutional architecture of fiscal rules exists. I think the big criticism is that relatively small movements in financial prices, economic conditions, can lead to a blowback of the kind of decisions you're making over capital spending, over financing public services, on tax, which, a bit like, where are the parallels between managing the public finances and investing? Well, the good approach to both is making decisions for the long term. The problem with fiscal rules is if they engineer too much volatility to try and gain them in the short run. And I think that's something of the risk that the current cycle, because of pretty small headroom, it has to be said, has got ourselves into.
And it's all based on forecasts and a kind of assumption of a false precision in my mind. Like the OBR, as good as a job they do, are not going to be able to accurately predict growth and inflation and all this stuff 5 years out.
Agreed. And by the way, a controversial statement to go with your dumb question, which is much of what Liz Truss was proposing was pretty sensible, actually. Much of the criticism that she had of the institutions has a degree of validity. What surprised me and my big criticism of her approach was she was one of the most longest serving cabinet ministers when she became prime minister. She would have learned something about how to use the ecosystem to deliver what she was trying to deliver. It appeared like she'd learned nothing. And what you do is you have this architecture. You don't just blow it up and ignore it. You work on how to use it to in your favor to deliver the outcomes you want.
Yeah, you just stayed the right side of getting a cease and desist letter there. Well done.
It's coming my way shortly.
But do you think that the decisions that Rachel Reeves has made has really constrained what she can do? And a lot of the problems we face now, or at least she faces, are largely of her own making. If she'd have been a bit more flexible with the fiscal rules, I don't think the bond market would have puked and we could have had a bigger stimulus.
Yeah, I mean, there was a debate over whether going to public sector net financial liabilities,
Per snuffle.
yeah, was preferable over public sector net financial worth, which brings a broader suite of assets onto into the measure of public debt. But I'm not accusing anybody on this podcast of having short memories, but in the immediate aftermath of the budget, for a couple of days, there was a bit of volatility in bond markets. And some of the criticism then was they'd just gone too far from moving from public sector net debt. So there is an element of performative art rather than science to all of this. And I think the big strategic mistake made by Rachel Reeves, absent the one that I'm talking about, the narrative that predated the budget, was this tax lock.
Yeah.
To not raise income tax, VAT, and in inverted commas, national insurance. And then this sort of nonsense they got into about, not raising taxes on working people. The reality is, if you box yourself in on tax, you actually create heightened speculation around relatively small but quite influential taxes, capital gains, inheritance tax, employer NICs, and you lead to the wrong outcome for the economy, even though politically you might go, well, that's the easier sell. We're not raising the things that people really think about as, if you like, pay packet taxes. I think that was the big mistake, because ultimately, if you wanted to raise that kind of money, just whack 1 or 2p on income tax rather than dancing around the handbags with, either employer NICs at a time, by the way, where there's an employer rights bill, there's the national living wage, there was speculation over pension contributions going up. That's an awful lot for employers to absorb. And just a final point, I know it's a pretty verbose answer, but look, I began my career as an economist 23 years ago at the Department for Work and Pensions. And there, when we did labour market reforms, you do small pilots, you'd analyse, you'd appraise their outcome, and if they worked, you'd roll them out nationwide. That approach has been overridden by just wanting to be in a rush and doing lots of things on that have all hit employers at the same time. So one of the deterioration in employer demand, which we're seeing in all the surveys at the moment, is not that individually all these things aren't probably in the right ballpark of what you want to do, but actually the layering of so much on employers at one time feels like a bit of a policy mistake, if I'm honest.
I think you're right that they boxed themselves in on tax. And I guess going back to fiscal rules, that is people's concern, isn't it? Is it a self-imposed boxing in? There are going to be times in the cycle where you might want to break the rules. I'm not saying we're at that point now, but we clearly are when there's an emergency like COVID or a financial crisis. But maybe there's other times as well.
I hope we learn the lesson. Maybe this is deeply, deeply naive. I leave my most naive comment to the end of the podcast, but I hope going into the 2029 election, if it runs that far, this parliament, of course, then I hope we don't get a situation where I understand why Labour put this tax lock in place, because if they didn't, the opposition would hammer them, no, you're not ruling this stuff out. But both sides plague on both their houses, and quite frankly, if another party emerges coming through the middle, it's because they've all been playing a little bit too much of a cute political game for too long, rather than focusing on what's really important. Generating growth, funding public services. You're sort of trying to create traps for each other. It's a bit of an unpleasant sight to behold, isn't it?
Well, Simon, that's just been brilliant. And I think people can catch up with your articles in the Times, which you write regularly and which are brilliant. Thank you so much for joining us.
It was my absolute pleasure. Really enjoyed the conversation.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a Pensioncraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.